and the buyers started to move the markets upwards. They covered some distance and created this high. The sellers then get into the mood and push the prices downwards, crossing below the opening price. The sellers then manage to keep the price down, and the candle closes near its lows. This indicates that the sellers have momentarily gained an advantage over the buyers. If we find another confluence at this point, then we can place a sell trade below the low of the pin bar, and we can keep our stop loss just above the pin bar. Pattern number 3, Doji. The Doji pattern is probably the only candlestick pattern that does not give us directional bias. However, it is essential to understand this pattern. A Doji candle is characterized by a candle with approximately equal wicks above and below a small body. The open and close are somewhere in the middle of the candle, and the body of the candle is very small. It shows that the buyers and sellers were very competitive during that time period. The sellers tried to push the prices down, while the buyers pushed the prices upwards. In the end, they were both equal to each other, and the price closed near the open. In itself, the doji tells us nothing. It can indicate a momentary pause in the move, but if we see a few doji in a row, the buyers and sellers are battling for a win. Usually, after such a pattern, the price will generally break out a wild move in either direction, so keep that in mind. The 3 patterns covered up until this point are a single candle pattern. Now we will move to intermediate patterns that consist of 2 candles. Pattern number 4, Bullish Engulfing Bar. A bullish engulfing bar is a 2-candle pattern where a green candle completely engulfs a red candle before it. This means we first see a red candle. Then, the next candle is a big green candle that completely engulfs the red candle. The high of the green candle is higher than the high of the red candle. Similarly, the low of the green candle is lower than the low of the red candle. The psychology behind this pattern is pretty simple. The sellers were in control during this red candle. Then, as the new candle opened, the sellers took the price lower. It broke the previous low, and suddenly the buyers stepped in. They overwhelmed the sellers and brought the price beyond the last candle's high. It shows that the buyers covered a more significant distance than the sellers. This means the buyers were now in control and ready to take the price higher. For the entry, we enter at the break of the high. We can place our stop loss below the low of the candle. Again, as I already said, we want to see other confluences, like the price action, to confirm a trade. Pattern number 5, Bearish Engulfing Bar. A bearish engulfing bar is a 2-candle formation where a big red candle completely engulfs the previous green candle. We first have a green candle. Then, the next candle is a larger red candle that completely engulfs the green candle. The low of the red candle is lower than the previous candle's low. Similarly, the high is higher than the previous candle's high. Let's understand the psychology of the pattern. First, we see that the buyers were in control as the price made this green candle. Then, as the next candle opens, the buyers try to push the price upwards. They manage to break above the high of the previous candle. Then, all of a sudden, sellers see these highs as an opportunity and they start to sell. Their selling pressure is so high that they manage to break beyond the low of the previous candle. The sellers traveled a lot of distance compared to the buyers. Hence, the sellers have now grabbed control of the markets. So we can place a sell trade below the low of this candle, and we can set our stop loss above the high. Advanced patterns. Pattern number 6, Morning Star Pattern. The Morning Star pattern is a 3-candle pattern that indicates a bullish price reversal. The first candle is a strong red candle with a big enough body. The second candle is a doji or pin bar candle with a small body and large wicks. The doji or the pin bar can be red or green. Then, finally, we have a big green candle that breaks above the high of the doji candle. The sides of this candle will determine the strength of the pattern. If the candle is as big as the red candle, then it is a good trade opportunity. If it is smaller than the red candle, it is a low probability trade. Lastly, if the green candle closes above the high of the red candle, it is a strong reversal candle. The psychology behind the pattern is pretty simple. First, we have a red candle. This shows us that the sellers were in complete control of the markets. They pushed the prices downwards. Then, we see a small doji candle. It shows us that buyers have stepped in and are pushing the prices upwards. Soon, the sellers lose their strength and the buyers take the prices higher, creating this green candle. It shows that the buyers have turned around the situation and are now likely to see an up move. To enter the trade, we will place a buy order above the high of the green candle. We will keep our stop loss below the doji candle. Pattern number 7. Evening Star Pattern. The Evening Star Pattern is the complete opposite of the Morning Star Pattern. Here we have a 3-candle pattern where the first candle is a green candle with a considerably big body. Then we have a small doji candle with a very small body. And finally, we have a red candle with a big body. The psychology behind this pattern shows us that initially, the buyers were in control as they created this green candle. Then, soon enough, the sellers entered and started to challenge the buyers. As a result, we see this doji candle. The doji candle indicates that the buyers and sellers are in a tug of war. Then, finally, the sellers win the battle and they start to move the price down. To enter a sell trade here, we place a sell trade below the low of this candle and keep our stop loss above the doji candle.